when the foreign exchange markets go awry within a week and there's a big change, some peg breaks or whatever in currencies, and currency exchange rates change bigly within a week, that means someone on those swaps is down hundreds of millions, if not billions of dollars within a week. And this is what can cause liquidity crunches. And so if you have a gold price doubling by the end of the year, which Zoltan Pozsar says explicitly is definitely a possibility if Putin catches on to this. And then from there, you have a toppling pyramid in the global banking system, which goes very well with a doubling gold price by the end of the year. And when that happens, you have about a quadrupling to quintupling silver price. Am I predicting this is going to happen at the end of the year? I'm not predicting that. But the fact that this is bleeding out into Credit Suisse analysts, especially people that understand the monetary system much more than the average analyst does, and I do have a certain respect for Zoltan Pozsar in that way. Doesn't mean he's always right. Now let's move to the ECB for a minute, where they're threatening to strike. From the European Central Bank, the inflation creators, they're threatening to strike because their pay raises aren't matching the inflation rate in Europe. From the European Central Bank, complaining that their pay hikes are not sufficient to cover inflation, or what they call inflation, meaning rising consumer prices, and why the executives of the ECB refuse to give them wage hikes that equal the inflation rate, because that could lead to a wage price spiral, which means by implication that everyone has to get poorer or else the system implodes. But when we take all this into account, it's looking good for the silverbacks. It's looking good for the gold bugs. We just have to keep holding on while the world figures out exactly how it's going to end before it does. The ECB itself believes that if you match wages to inflation, meaning if you maintain your purchasing power, if you so much as maintain your purchasing power with your salary, you risk a wage price spiral, which could destroy the currency in a wage price spiral. I already said wage price spiral. That means that the ECB is mandating everyone to get poorer, to lose purchasing power, or else the currency could die, which makes sense because inflation is designed to rob the middle class in favor of the rich people that get money from the inflation spigots. I'm not talking about rich people generally, but the ones who profit off of inflation purposely. So this statement is unusually candid by the European Central Bank. They admit that maintaining purchasing power, not even getting richer, but maintaining purchasing power endangers the currency. And they're right, it does, which means that everyone is mandated to get poorer at their expense until, of course, the inflationary system dies and gold and silver take their place as the monetary reserve of the world, which in turn, as Zoltan Pozsar said, destroys the paper gold markets and in turn the paper silver markets, causes a short squeeze, which causes all the money in the reverse repo facility to flood the banking system. In the meantime, the dollar collapses. Why would Putin try to pay in gold and give double the amount of oil when he could just sell half the amount of oil in dollars and then buy his own gold with dollars? The answer is it's very difficult for Russia to buy anything with dollars these days because of the international sanctions. So by putting sanctions on the dollar itself, the dollar becomes devalued for Russia because they can't use it to buy stuff. So that gives Putin an incentive to take payment for oil in gold terms instead. And now if he takes, for example, 2 barrels of oil, he sells 2 barrels of oil in exchange for 1 gram of gold, that means that people on the international exchange sell their dollars to buy gold, to buy oil, Russian oil, at half the price. And that changes the arbitrage between dollar and gold and doubles gold prices in dollar terms. By doing this, Putin can collapse the US dollar in gold terms, and by doing that, he collapses the dollar against everything because, as I've said over and over and over again, the only thing that gives the dollar value to exchange in terms of anything is the fact that it can be exchanged for gold. So if you lower the dollar's exchange value in gold terms, you lower its purchasing power in terms of everything. And so Pozsar says this in his own words, that in order to maintain futures positions, short futures positions on the COMEX, gold cannot be used as a money. Now, there is no guarantee that Putin is actually going to do this, but eventually someone somewhere on this green earth is going to pull the rug out from under the dollar. And the rug that is under the dollar currently is a rug of gold. And when gold goes up, the public goes after what? Of course, silver. Now, there's another paper that was circulating around Twitter or on the internet this week. That is a paper from the Bank of International Settlements about the $80 trillion in off-balance sheet FX swaps that exist in the banking system all over the world. And there's one paragraph from this paper from the Bank of International Settlements that explains what the problem here is. Talking about the $80 billion of FX swaps off balance sheet, the very short maturity of the typical FX swap forward creates potential for liquidity squeezes. Almost 4/5 of outstanding amounts at end June 2022 in graph 1B matured in less than 1 year. Data from the April 22 triennial survey show not only that instruments maturing within a week accounted for some 70% of FX swap turnover, but also that those maturing overnight accounted for more than 30%. Okay, so you have 70% of this FX swap stuff off balance sheet in financial institutions across the world. Why is it off balance sheet? Because notionally, all of these FX swaps are backed. There's a swap made of currencies on both sides, so both currencies are backed by both currencies since you're just swapping assets here. So what is the risk here? Well, if they expire within a week, 70% of these things expire within a week, that seems like an almost riskless trade, and in most cases, it is. Silver stocks at the LBMA came out yesterday, the 5th business day of each month, and the monthly silver stocks are down another 11.7 million ounces to 840,347,000 ounces. That is a 2.5% of the movable silver float because 370.9 million of those ounces belong to the ETF SLV, which, by the way, has not risen in holdings since silver has bottomed. The paper traders are still out of this market. We want to keep them out as long as possible and leave it up to the stackers to move the spot price. Also, if we look in New York, out of London and into New York, the registered silver supplies stopped draining for a little bit, for about 6 weeks, but they are draining now again, and they are down to new lows at just 33.05 million ounces, despite the rise in the spot price, which should, all things being equal, stop the flow of silver out of the COMEX, except that it's not this time, which means that the silver bugs are keeping up the pressure, which is exactly what we want to see. And the trend line down since silver squeeze remains very much intact. Someone, somewhere on this green earth is going to pull the rug out from under the dollar. And the rug that is under the dollar currently is a rug of gold.